All right, let's talk about a real head-scratcher from Wall Street. Williams-Sonoma comes out with fantastic earnings, they raise their forecast for the year, and the stock drops. Today, we're going to break down exactly how great news can lead to a bad day for a stock and what that really tells us about the market right now.
So here's the deal. The big mystery we're digging into, Williams-Sonoma reports fantastic news. They didn't just meet expectations, they crushed them. They even told investors the rest of the year looks better than they thought. So you'd think the stock would have just taken off, right? Well, it didn't. It actually finished the day in the red. Let's unravel this thing.
First things first, let's just take a moment to appreciate how good the news actually was. I mean, the second quarter results were impressive, plain and simple. This wasn't a fluke. It showed a company that is really firing on all cylinders.
Okay, let's start with the bottom line, the earnings. Williams-Sonoma posted earnings per share of $2. The consensus on the street, $1.79. That is a massive 11.7% beat. It tells you the company isn't just selling stuff, it's making really good money doing it. And it wasn't just the earnings. The top line, the revenue, was also really solid. They brought in over $1.8 billion for the quarter, which, again, was more than analysts were expecting. So it's clear people are out there spending, and Williams-Sonoma is getting a nice piece of that pie. But here's the number that really tells the story. Comparable brand revenue was up almost 4%. Now this metric is so important because it filters out the noise from new stores. It tells you how the existing business is doing. And this number says the core of the company is super healthy and growing strong. And get this wasn't some one-trick pony situation where one brand carried all the weight. The performance was incredibly broad. Every single one of their big brands posted positive growth. You've got Pottery Barn, West Elm, the main Williams-Sonoma brand, and even Pottery Barn Kids and Teen. That's a sign of some serious, widespread strength across their whole lineup. All right, so beat on earnings, beat on revenue, strong comps, and they even raised their guidance for the future. This should have been a slam dunk, right? A total home run. But the market's reaction? Well, that tells a completely different story. And this is the million-dollar question, isn't it? If the business is humming along this well, why would investors be hitting the sell button? The answer, it turns out, is all about the difference between looking at the past, even the recent past, and worrying about the future. This chart just lays out the whole paradox perfectly. Look at this. Before the market even opened, when the results first hit the wires, boom, the stock shot up over 4%. Investors were loving it. But then, as the day went on and as management started talking on their conference call, all that excitement just vanished. The stock reversed and ended up closing down almost 3%. Something clearly spooked them. And here it is. This is the answer. While those amazing Q2 results were a look in the rearview mirror, investors were busy looking out the windshield. And what they saw was a massive storm cloud forming on the horizon. And that storm cloud has a name: tariffs. This right here is what was on every single investor's mind. The whole tariff situation has gotten incredibly complicated, and the potential costs are huge. We're talking a possible 30% tariff on goods from China, a whopping 50% from India, 20% from Vietnam, not to mention big tariffs on raw materials like steel and aluminum. For a global retailer like this, that's a massive, unpredictable new expense. And if you want the exact quote that sent a shiver down the market spine, this is it. The CFO, Jeff Howey, he just laid it out there in plain English. He said their expected tariff costs have literally doubled in just the last 3 months. That was it. That was the dose of future uncertainty that completely overshadowed all the great news they had just reported. But here's the thing. This is not a management team that just sits on its hands and hopes for the best. In response to this very real threat, they came prepared. They laid out a very clear, very detailed playbook for how they plan to navigate this storm and protect their bottom line. So what are they going to do? Well, it's a comprehensive 6-point plan. They're basically hitting this thing from every possible angle. They're pushing their suppliers for better prices. They're actively moving production out of high-tariff countries. They're finding efficiencies in their own supply chain and cutting expenses. They're beefing up their made-in-USA product lines. And as a last resort, they'll carefully raise some prices.
And you have to remember, this isn't just about playing defense against tariffs. The underlying business itself has some serious growth drivers humming along. Their B2B segment, that's business to business, grew by 10%. Their new up-and-coming brand Rejuvenation is on fire. That's 7 straight quarters of double-digit growth. Plus, they're innovating with AI to improve customer service and striking smart partnerships to bring in new customers. The engine is still running strong.
Okay, so we've looked at the awesome quarter, we've understood the tariff fear, and we've seen management's game plan. So now it's time for our take. This is the part of the show we call The Next Call, where we put it all together and give you our forward-looking perspective.
You know, when you boil it all down, the whole story for Williams-Sonoma comes down to this classic Wall Street debate. On one hand, the bull case is just rock solid. Great fundamentals, a management team that knows how to execute, killer brands, and a history of giving cash back to shareholders. The bear case? It's almost entirely about stuff they can't control, that tariff uncertainty and what it could do to their profit margins. So where do we land? Our call is outperform. We think the market is getting way too hung up on the tariff headwind. Yes, it's real, but we believe it's manageable for a top-tier company like this. This sell-off feels like an overreaction that's ignoring the fundamental strength of the business and management's proven ability to navigate tough times. Now, whenever you see a big disconnect like this, a great company with a falling stock price, it gets some investors thinking about a contrarian opportunity. So let's just explore one potential way someone might think about playing this situation if they believe the market got it wrong.
The core idea, the thesis here, is pretty simple. You're betting that this stock drop is just a temporary overreaction to a macro fear that the company can actually handle. For someone who's bullish on the company long-term, this dip could look like a really attractive entry point. So how would someone play that? Well, one of the more advanced ways to express that bullish view is with something called a bull-call spread. Now, we're not going to get deep into the weeds of options here, but the basic goal is to make a bet on a rebound up to a certain price while also capping your risk if you're wrong. It's a defined risk way to be bullish.
So just as an example, a trade might look something like this. A trader could buy an option that profits if the stock goes above 200 and then sell another option to cap their gains around 215. The whole point of a structure like this is to profit if the stock bounces back over the next few months, maybe as the market looks past the tariff noise and refocuses on those strong fundamentals.
And of course, we have to say it, this is not financial advice. This is for informational and educational purposes only, so please always do your own research. But the whole Williams-Sonoma story leaves us with a really critical question for the market today. In this age of constant uncertainty, do strong fundamentals still win in the end? Or is the fear of what might happen the only thing that matters anymore?